Hello viewers, welcome to this edition of Galaxy Stock Bites. If you had invested in the Nifty 20 years ago and just stayed with it, not sold, no panic selling, no buying, no trading, no fear, just disciplined investing for the last 20 years, you would have made 13% annualized returns on your investment. But how many of us actually did it? Very few. Did we not have access to the knowledge or the information that this is possible? Yes, we did. We read many books by successful investors, by sociologists, by behavioral scientists. We all know that investing for long term yields results. Let's take a book called Psychology of Money by Housel and just see if we had followed the principles laid down by him in that book, where would we stand today? Let's take it one by one. Housel's first lesson is compounding. Stay invested and the growth takes care of itself. If you stay invested long enough, no panic selling, no frantic buying, no chasing returns, just buy and hold for a long time. If you had done this, as I just stated, just investing in the Nifty would have yielded an annualized return of 13% for you. But there's more to it. Let's look at the next lesson. Volatility. We are afraid of volatility. Every time the price of a script falls or securities come down, there is a correction in the market, we are scared. Fear comes to rule. It's then that we should do just the opposite. We should not be afraid of the volatility, rather treat the volatility as a fee, an entry fee to be able to buy the securities at a lower price. Let's take, for example, what happened in 2008 during the global financial crisis. The Nifty fell by more than 50% in a matter of days. Had somebody had the forethought not to be scared and to buy the fall, let's see what happened the year after that. The Nifty ran up 75%. What do we understand from this? Volatility is not a foe to be feared, but an opportunity to be embraced. That's the second lesson by Housel. Volatility is a fee. The third lesson is about discipline and behavioral gap. What do we as investors normally do? Every time the markets fluctuate, we act in panic and we do things that we normally would read in these books that advise us against doing. For instance, if the Nifty falls, we sell in panic. When the Nifty rallies, we buy in greed. Had we not done any of this, not bought in the panic, not sold in the panic, or bought the greed, we would have saved ourselves over 5 percentage points on an annualized basis and ended up with a Nifty return or ended up with an investment return of 19% instead of the Nifty return of 13% which investors actually got. So what do we get out of this? Behavioral discipline is of paramount importance. Last but not the least, you don't need to be a mathematical or a financial genius to make money in these markets. You just need to have average knowledge and a lot of discipline. So what's the verdict out of this? Follow those who have good advice and follow it for the long term. Morgan may be one of the few who has written a great book on investing called The Psychology of Money. There are dozens of other leading investors who have come up with great advice. So in our next edition, we'll take up one more book to see how our viewers and investors can benefit from it.